Hey traders, this is Blake Morrow with Trader Summit, and with me always on Friday, I have Mr. Jim Welsh from Macro Tides. Good to see you, Jim, and we have a lot to unpack this week, right?
We certainly do, and this is the best day of every week, right? You and I having a chance to chat.
It is, it really is, and it's Friday too. I'll give it that.
Well, yeah, I didn't mention that.
Well, let's talk about a couple things. Yeah. First of all, we had inflation data come out today, came in line with expectations. President Biden, like he kind of warned the general public, look, the inflation data is going to be strong, but don't worry, that's in the rears. It's going to be interesting to see what Joe and Sally Public say when they're sitting at home in their recliners thinking, whoa, that's a pretty, it's inflation. So we got that. Let's unpack the moves that we've seen since then. But also we have the FOMC next week, which is a big deal. And I know you brought us a chart for the S&P. So make sure you guys at home, we have a lot to go over today. If you like what Jim does, give him a thumbs up. Make sure you subscribe to the channel down below. If you're watching us on YouTube, it is free to subscribe. And Jim, let's hit it. What do you make of today's inflation data that came in line with expectations, but still a pretty high print? So a very high.
It's a real high print. It's like the highest since I think June of 1982.
That's nothing.
Where the Fed funds rate was in June of 1982, I'm sure it was north of 10%. So just to put the contrast in terms of what monetary policy was doing back in 1982 versus where we are today. So
you always hear like from people, the generation after me, my parents' generation, talking about interest rates in the 80s, how they had to, when they bought a house, they were paying, they qualified for a 13% mortgage or to higher, so tell us why is it different? We got this inflation here. Rates are so low right now, and this disparity between the way it was then and it is now. But I know that's a long
one to answer.
Right. So where do we go from here now that inflation's at these levels?
Well, again, I think as you said, it came in line with expectations, and I think that's why the response from the markets fairly muted despite the headline. I think the key is next Wednesday when the Fed meets. I believe the Fed is going to increase their taper to 30 billion.
Wow.
And from 15. And I really believe it's an issue of credibility. Before the November 3rd meeting, I was saying they should go to 20 billion because, there's no reason for them injecting the amount of liquidity they are when housing prices were up almost 20%.
Yeah.
So I think they're going to go to 30 billion. That would wrap it up by the end of March. That number might shock people if it happens. So I think that's the key for what the Fed is going to do. Plus, irrespective of the taper number, Blake, I think Powell is going to talk a hawkish wave, in the sense of if inflation persists more than what we expect, we have the tools to combat it. And we won't be reluctant to employ those tools. He's not going to talk about future meetings. He's not going to talk about if and when they may raise interest rates. That won't come up. He's going to try to express the attitude as, hey, if we need to, we'll respond accordingly.
All right. Well,
take that in stride.
So, even though inflation data came in line with expectations, it's definitely going to, it's not going to alter the Fed and the Fed. Well, not going to alter the Fed. What I mean by that is that already expectations are rising for increase in taper. But I guess where the rubber meets the road is when they wrap up tapering. It still isn't raising rates yet, right?
Right. No. And again, we have to go back to Powell has made a distinct separation between inflation equates to the taper. So obviously the core rate on the CPI, I think was 4.9.
Yeah.
So, it came in expectations, but in terms of what the Fed is trying to accomplish, inflation is crazily above any target they have. So rates are a whole separate issue. That's the labor market. Now, as I wrote in the December Macro Tides, I think the labor market's tighter than the Fed realizes. But we don't have to deal with that until we get into the first quarter. So again, I think the Fed is going to increase the taper, and I think there's a good chance that sometime in the second quarter, they will raise rates because we do have an election in November of next year. I'm sure they're going to want to get at least one rate increase, again, to regain credibility.
You talk about elections, and it's interesting that, in like right now on Capitol Hill, that's what everybody's talking about. Everybody's talking about inflation. It's not everybody's talking about QAnon or, Biden or Trump or any, they're all talking about inflation. So that is a big concern for Joe and Sally Public right now.
A Gallup poll just came out, Blake, and the numbers were pretty broad-based in terms of inflation being the number one concern for people of really almost all income levels, but particularly those who have incomes less than 60,000. And, Biden can make a speech, but the reality comes down to when people go to the grocery store and the gas pump, that's what's going to convince them that things are going to ease, because they start to see gas prices come down. Food inflation is not likely to come down much for quite some time. But that's where the rubber really hits the road in terms of the consumer's perception, is what are they experiencing? And I don't think that's going to materially change in the next handful of months.
Okay, so what we did is we talked a little bit about inflation, or a lot about inflation. We talked about the Fed this next week. They're going to increase, potentially here, increase the pace of taper. How are equity markets going to respond to that? Because right now, you got equity markets that popped higher on the news, because we didn't see a 7% CPI non-core, outright CPI print. Maybe that's the reason why stocks actually hit highs. We're what, less than 1% away from all-time highs. Right. What does the market do from here? And do you want me to show you the chart?
Yeah, I think we should do that. I think that'll help. Because to me, somewhat of a coin toss right here. As you know, back in, I think it was when the chart comes up. Yeah, we did a broad, or, one of these webcasts back in late, it was in November, I think 15th. On the 12th, it got broadcast on the 15th. The expectation was the S&P is going to rally above the 47.18 high, which happened in early November, and then have a 4 to 6% pullback. So we got to 47.44, and immediately we sold off. As you and I discussed last week, the decline is very, very choppy into the low that we saw late last week, and it looks like a wave A potentially. My belief was that we were going to rally to 46.50. As it turned out, it extended beyond that, which is a sign of strength, got up to 47.05. But it's only 3 waves so far, which is why you can see I have A, B, C up where we just hit this high. Yeah. And so we're at a crossroads, Blake. Either we're going to push up towards 47.30, or we'll have another little dip that takes the S&P below the lows of yesterday, maybe to 46.50, and then have that move up. The alternative is you got 3 waves up for wave B, as noted in the red, and we're going to then see a C wave that takes the S&P below the lows of last week. So we're at a point, to me, where being flat makes sense, because the market is going to tell us what is the outcome going to be. If it rallies up to 47.30 and you then have 5 waves up off the low from December 3rd, that to me is wave 1 of wave 5. And as we've talked, my expectation was we were going to have a pullback and then a push above 4,800 in the first quarter. So we're at a point where, to me, the market is going to tell us what it's going to do here. So I think you just have to wait to see what the Fed does. And always, like today, it isn't so much the news sometimes, but how markets react to it. So maybe the Fed does 30 billion and the market doesn't care. Fine. We'll have that rally up to 47.30 or so. And we're going to get a wave 2 pullback before a much bigger rally takes us to above 4,800 going into early next year.
Now, Jim, it's amazing to me. I know, the additional bond purchases that the Fed is doing every single day, that is adding liquidity to the market. So I get that concept, but the market usually is a forward pricing mechanism. And so, here we are, as the Fed is tapering, we didn't have a taper tantrum. as the market was a little fearful of, earlier this year. We're at all-time highs, knowing that the Fed is either going to continue tapering or, worst case scenario, pick up the pace of tapering. Yet we are still at all-time highs, and so what's going to pull the market down? Because is this the market's way of saying, yeah, we see that they're wrapping up tapering, but it's going to be a long time before the Fed actually lifts off zero, or where they're currently at a 0.25% or whatever it is. So
okay, basically we haven't talked about this, but I have what I call the major trend indicator, and its purpose is to identify, are we in a bull market or bear market? It's still comfortably in the bull market phase. So to me, all of this stuff has to be put in the context of, are we in a bull market? Yes. So what that implies is surprises are likely to come to the upside. Now, I think, again, if we get a rally above 4,800 in the first quarter, I think the market is going to have a 10 to 15% correction after that rally happens, because it's not just the taper. I think the inflation news is going to continue to be bad into early next year. And people are going to leapfrog. Okay, the Fed's tapering. Okay, let's say they do 30 billion. They're done by March. Then the game is going to be, well, when are they going to raise rates? How much are they going to raise rates? I think there's the potential they're going to price in more rate increases that leads to that 10 to 15% correction later in the first quarter. And then the reality is inflation is going to really drop sharply by mid next year. Core are going to be up pretty high. But the point being is the markets may be ready to price in 3 rate increases for next year, and we might only get 1. And that's why I think you get the 10 to 15% pullback, and then I think there's another move up. And the bottom line here, like I said, the major trend indicator says bull market. We got to step back. The economy is in good shape. So until a good reason to sell materializes, and that the best reason is, yeah, the economy is rolling off a cliff and going into a recession. We're nowhere near that. So to me, those are the fundamental and technical reasons why I still think we're in a bull market. And now we're just trying to identify, if you will, another excellent entry point. And if I'm right about that 10 to 15% pullback early next year, after we go up to 4,800 or so, that's going to provide, I think, a really good entry point. Because I think subsequently the market's going to rally over 5,000 after that pullback.
Wow.
So
okay, it's a big call.
Volatility. Yeah, it's going to be a lot of volatility, but we'll take it one step at a time.
Yeah. All right. Well, Jim, I get, just one last thing I want to leave you with, or maybe give you a question about. This persistently high inflation, and you're like, well, the economy is still strong, but at what point does it really pinch the consumer? At what point does the consumer, as so many Americans, I know we have a little bit of better of a cushion following all the Fed and the monetary and not only the monetary stimulus, but also the fiscal stimulus. Americans are better positioned, but at what point does inflation bite the consumer, and the consumer says, you know what, I can't go to McDonald's because the milk costs too much or the gas costs too much? At what point does the consumer just tighten up? What do you think?
Well, bottom line, we're not there yet, because there's more than $1 trillion, I think closer to $2 trillion of excess savings, and even the bottom 50% have an extra 500 billion or so. I had this in the December macro tides. So that cushion that you alluded to is right on, that it'll postpone when that bite is going to happen. The other thing is, if we do in fact start to see some things moderate, that will obviously help lower energy prices and the food prices that I think will ultimately come down. And again, in the second quarter, we're going to see a very sharp drop in some of just the year-over-year calculations, Blake. So they're boosting it now. By the end of the second quarter, those things are going to be subtracting a lot. So psychologically, that'll also make a difference to what people are, again, it all goes down to what they experience. But if you hear the headlines, inflation is now back down below 4 in the headline. Well, that's a big drop from 6.9 or whatever it was this morning.
Yeah.
That's what's going to happen in the second quarter.
All right. Well, Thank you for your thoughts. And what is this? I'm sorry. What did you call it? Macro tides that you speak of? Can you explain that a little bit?
Sure. Well, I do a monthly letter which really focuses on the fundamental equation, and I referenced a couple of things during our conversation today from the December letter, and then a weekly technical review which looks a little bit at fundamentals, but mostly chart analysis and technical analysis. So I try to blend the two, and obviously a weekly report gives people more timely information. And when required, I send updates. So
yeah, and that's a really nice thing that you do for your subscribers. I've personally seen those updates, which is great. So Jim, I want to say it's great to always see you on Friday. Thanks so much again. If you guys and gals are watching at home, you love what Jim does, make sure you check him out. Make sure you give him a thumbs up here at this on this YouTube video. And Jim, we'll see you next Friday. And that'll probably be the last one as we wrap up the year. Close to. We'll figure it out as it comes, right?
Yeah, sounds good. All right, Blake, have a great weekend.
Jim, you do the same thing. Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.